Private companies can indeed issue stock without going public. Unlike public companies, privately held businesses don't trade on exchanges and aren't subject to the same SEC filing requirements, giving them more flexibility and control. All companies in the United States begin as privately held entities. These private companies come in 5 distinct types, each with different shareholder structures and tax implications. Sole proprietorships have a single owner, responsible for all assets and liabilities. Partnerships involve at least 2 owners, sharing responsibilities. Limited liability corporations allow multiple owners with limited liability without formal incorporation. These corporations can have up to 100 shareholders and avoid direct taxation on profits. C corporations can have unlimited shareholders but face double taxation. Many businesses deliberately choose to remain private rather than pursue an initial public offering. This decision often stems from the desire to maintain control over company operations and long-term vision. Private status also means avoiding the substantial costs associated with going public, including SEC fees, regulatory compliance expenses, and stock exchange listing fees. Additionally, private companies enjoy greater operational flexibility, without the pressure of quarterly earnings reports, and can keep their financial details confidential from competitors. If you own a private company and want to issue stock, you'll need to first determine the value of each share. This can be challenging since private companies aren't required to publish financial statements. The most reliable approach is obtaining independent business valuations from reputable firms, preferably getting multiple assessments to compare values. After establishing share value, you must decide which type of private stock offering best suits your needs. Private placement offerings, also known as Regulation D, limit fundraising to less than $1 million with restrictions on investor types. Limited partnership offerings are only available to companies organized as limited partnerships. Small corporate offerings allow selling to unlimited investors and permit marketing to potential investors. Selling private company stock presents unique challenges compared to trading public shares. Several options exist for shareholders looking to sell, including company buyback programs where the issuing company repurchases shares. Some specialized secondary markets like Forge or EquityZen facilitate private stock sales, though company approval is typically required. Direct private sales between individuals are possible, but usually need board approval and must follow transfer restrictions. Many shareholders ultimately wait for exit events like company sales, mergers, or initial public offerings to liquidate their holdings. Private companies frequently use stock as part of compensation packages to attract and retain talented employees. Incentive stock options allow employees to purchase shares at predetermined prices after vesting periods, often with favorable tax treatment. Non-qualified stock options function similarly but with different tax implications and are commonly offered to contractors or board members. Restricted stock units promise shares upon meeting specific milestones like employment duration or performance targets. Phantom stock provides financial benefits of ownership without actual equity. Investing in private company stock carries significant risks that potential shareholders should understand. The most notable challenge is lack of liquidity, as private shares cannot be easily bought or sold. Valuation uncertainty exists without public market pricing mechanisms. Private companies provide limited financial transparency since they aren't required to disclose performance regularly. Early shareholders face dilution risk as more stock is issued. Transfer restrictions often limit selling options, and investors may wait years for a liquidity event to realize returns. Many private companies now use electronic systems rather than paper certificates to track ownership. This direct registration system registers shares electronically, eliminating the need for physical certificates. This approach offers several advantages. Companies don't need to issue and track paper certificates, can more easily control transfers, and can maintain more accurate ownership records through specialized software. The tax implications of private company stock vary based on acquisition method and stock type. Incentive stock options may qualify for favorable capital gains treatment if holding requirements are met. Non-qualified stock options typically incur ordinary income tax upon exercise. Restricted stock units are taxable when they vest. The 83B election allows employees to pay taxes upfront on restricted stock, potentially saving money if shares appreciate significantly. Private company stock offers both opportunities and challenges. While it provides a way for companies to raise capital without going public, and for employees to share in company growth, investors must navigate illiquidity, valuation difficulties, and complex tax considerations. Understanding these dynamics is essential whether you're issuing stock as a company owner or considering an investment in a private business.